Did the stock market just hit bottom? We're going to explore our favorite technical indicators to find out where stocks, ETF funds, and your retirement account are headed. So stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. The past 6 months have not been very favorable for most people who are building their retirement nest egg or even thinking about retiring early. So we're going to investigate the current market conditions and see where the market is headed. Have we hit a bottom, or is there more pain to come? In addition, I want to remind you, on this channel we discuss Social Security, investing for retirement, saving for retirement, and much more. We're looking at the chart for the S&P 500 Index Fund, the SPY. This is a weekly chart, goes back about 2 years. The S&P 500 is a diversified index fund. It contains a portfolio of 500 of the largest companies in America. You can see here since January of 2022, it's been on a downward trend. Question is here, have we hit a bottom? Now, the last time that we talked about the market, we were back up in this range here, and we said that there was the potential that we could go lower, which we did. We're going to take a look at a couple of indicators here that might be giving us some hints where the market is headed from here. We're looking at the AAII Sentiment Survey. What this is telling us, as of June 15th, there's 19.4% investors that are anticipating the market to go higher. They're bullish. There's 58.3% of the investors that are bearish. They're anticipating the market to go lower. Typically, contrarian analysis tells us when there's more investors on one side of the market will tend to turn around to the other direction. So in this case, we have a lot of bearish investors anticipating the market to go lower. So there's a good probability that the market will turn back higher. We're looking at a chart of the AAII bullish sentiment. The blue line represents the S&P 500 and the black lines represent the number of bullish investors. You can see where we're at right now. We have an extreme low number of bullish investors. They're very bearish on the market. If you look in the past, typically when we reach these lows in the bullish sentiment, then we eventually get a market rally. These two charts are telling us that there's a high number of investors anticipating the markets to go lower and a low number of investors who are anticipating the markets to go higher. Contrarian analysis tells us, at least for the short term, the markets will do opposite of this. That means there's a possibility we have a chance the markets move higher at this point. We're looking at another interesting chart. This is the number of stocks in the S&P 500 that are above the 200-day moving average. Right now, we're around 12% of the stocks above the 200-day moving average. You can see in past history when the number of stocks above the 200-day moving average gets down below that 10% level, the markets have a tendency to turn back higher. Here's the number of stocks in the S&P 500 above the 50-day moving average. Right now, we stand around 3 or 4% of the stocks that are above the 50-day moving average. It's a very low amount. When you look at the highs when the market's in a bull run, it can be 80, 90% of the stocks above the 50-day moving average. And past history shows us when we reach these levels, we have a chance of the market moving back higher. The price of stocks become very attractive at these low levels, so investors start to step in and buy at the lows. For those that don't use charts for their investing, we're looking at a chart here of Microsoft, and the red line represents the 200-day moving average, and the blue line represents the 50-day moving average. So you can see here Microsoft is below both the 50-day moving average and the 200-day moving average. When stocks start to move back above their 50-day moving average, positive things start happening. We're back to the weekly chart on the S&P 500. So am I saying going all in right now on the S&P 500 or do a lump sum investing right now? I'm not saying that at all. I think right now we have a chance for a bounce in the markets, but I don't see this as the low as of right now. Those who are doing dollar cost averaging through their work 401k or individually, dollar cost averaging is still a good way to enter the markets with your dollars. When we talk about dollar cost averaging, if a person had $12,000 they wanted to put into the market, you could break that up to $1,000 per month, and you're going to invest a small amount each month. If the market moves lower, you're buying shares at a lower cost. Now, I don't think this is the low in the markets right now. Now, for short-term investors, they may have an opportunity here to invest and then take profits when the market peaks out again. Keep in mind the Fed is raising rates. We have high inflation, high gas prices. None of that has officially changed yet. We're still raising rates. They say they're going to continue raising rates. That still can cause damage to stocks and also to individual investors and consumers. So nothing's changed, but there is a possibility here the market could at least bounce higher up into resistance areas. So I want to thank you for watching here today. Stay tuned for our next update.